Early Exits 2.0. Why early exits continue to rise. My name is Len Zapalowski. In my previous video, I discussed global trends in early exits. Today, I will highlight how you can capitalize on this trend in one of the hottest M&A markets ever. Large companies have abandoned disruptive innovation. Risk-taking and innovation are part of the startup DNA. However, large established companies can only innovate within a narrow range. Corporate R&D departments struggle to decide how to apply funds between defending and maintaining legacy products versus launching new products. By contrast, smaller tech companies live in a world of clean sheet ideas. Developing disruptive technologies fuels their ambitions. However, tech startups often lack the budget and management skills to fully exploit their developments. It therefore often makes sense for larger companies to acquire these new technologies and products and access to new markets that come from these smaller, innovative and faster companies. That way, large companies can stay ahead of their competitors, continue to grow, and avoid obsolescence from new entrants. This graph depicts the decreasing life expectancy of large companies on the S&P 500. In 1955, companies stayed on the S&P for an average of 61 years, whereas by 2015, the lifespan had dramatically shrunk to 17 years. Each bar represents a rolling 7-year average of the average lifespan. A key reason for this increasing corporate mortality is their inability to innovate in an environment of rapid technological advancement. Another insight into how large companies are innovating is that the R&D expenditure is now rivaled by investments from the venture capital industry. In 2020, VCs invested $156 billion into startups. In fact, many large corporations have surrendered the battle by starting their own venture capital arms for investing in startups. Total business R&D expenditures in the USA is about $500 billion. In 2020, the value of share buybacks totaled $520 billion. So while corporate America's investments in technology remain significant, it is sobering to contemplate that it spends as much on buybacks as it does in innovation. Additionally, this graph shows a $600 billion yearly expenditure on US R&D, which also includes US government spending. Startup tech companies excel at developing new technologies quickly and cost effectively. Scaling the company requires much more capital and a different skill set. However, there is often no need for startup companies to attempt the difficult and risky challenge of scaling up a larger operational infrastructure when large corporations already have these elements in place. The strategic question becomes, where is the value add of the entrepreneurial company in the existing demand and supply chain? The startup phase is followed by scale-up, which has a different set of challenges. Often the founders do not have the scale-up skills and certainly not the skills to operate the enterprise at scale. It's rare that the founders retain their jobs through scale-up to full scale. Consider the organizational characteristics of startups, scale-ups, and scalers. The financial risk implications for entrepreneurs along the startup, scale-up, scaler are profound. As startups scale, their companies are more valuable. However, investment capital is needed to fund the growth. As a result, entrepreneurs may suffer dilution in their ownership of the startup. In theory, the company's growth in valuation exceeds the rate of dilution, so that the entrepreneur's stake, while smaller in percentage, is worth more. But this is where risk must be considered. Scaling it is not easy. There are any number of events that could crater the company's worth, including technical obsolescence, poor market response, or management errors. So entrepreneurs and their investors may take the path to scale and grow when on a risk-adjusted basis, they may be better off financially exiting at an earlier stage. Angels play nice. The nature of seed startup funding has changed over the last 25 years. Whereas institutional money, for example, venture capitalists, was important in the 70s and 80s, at the seed and first stage, angel investors now become a significant factor in these early stage investments. These new investors tend to work to make the companies they invest in successful in a different way through hands-on help or networking. Venture capital relies on a portfolio approach to success. and they tend to push each investee to a possible unicorn outcome, with the unhappy result that some companies overreach themselves and fail. By contrast, angels have less of a portfolio approach and treat the company as if it were their own, and may be happy with a 2 or 3 or 4x exit in the near term. Angels now contribute $2 to $3 billion in investment each year at each seed stage. Hot markets for M&A. The final driver is that market valuations are at an all-time high. The Nasdaq, S&P 500 are at record levels. There is plenty of capital in the economy, with the money supply at an all-time high. This abundance of liquidity has fed more capital into venture capital, private equity funds, and family offices. All funding sources are flush with cash. The cost of money is at an all-time low. Fund managers are becoming more aggressive in the search for yield. Startup and scale-up tech companies, once considered too risky for traditional investors, are now being added to portfolios to generate additional yield. With all these capital providers hungry for new opportunities, there has never been a better time to sell a startup or scale-up tech company to an idea-deficient acquirer. So, how do you have a successful early exit? There are 4 key drivers why early exit companies are successful. To find out more about this, tune in to my next post.